I'm Mahesh, is my voice reaching you?
वॉइस आ रहा है. Yes.
Wonderful. This time I can assure you there is no delay. So let's start fresh. I have a morning note in front of my hand, whereas the tone of the note is certainly very constructive, and it really talks about a stronger verdict and what it means to the political economy. But the fine print is not really talking about a big earnings upgrade or a big market re-rating. So if the political mandate is strong, do you think the economic re-rating may not be that strong? Is that what you're trying to indicate?
Yeah, so what I'm trying to highlight is that political cycle, economic cycle, and then there's a market valuation cycle. These three are different things, and yes, one is correlated to the other, but there doesn't have to be 100% correlation. So political strong mandate will definitely translate into better policy making and will definitely have a bearing on the economic cycles for sure. But I think that correlation will be played out over a medium term. But I think in the near term, we still have to contend with the near-term issues like the liquidity-related issues for NBFCs, the consumption slowdown that we are facing. The housing market is probably showing some signs of improvement, but not in that greater shape just as yet. So that's on the economic cycles. On the market valuation cycles, clearly the domestic flows hopefully will now begin to start improving. For the last 7-8 months, we have been seeing a declining trend, and with this strong mandate, the domestic investor sentiments definitely improve. From my discussions with the foreign investors, the sentiment over there for India relative to the other emerging markets is also better at this point in time. But there is a broader global concerns on the US, China, trade war, etc. Also this MSCI rebalancing thing, which will probably cause some outflows from the Indian market as far as the foreign passive money is concerned. So keeping all these things in mind, while on a relative basis India looks very, very attractive in the emerging market space, in the Asian market space, but how much of that translates into a large amount of foreign money coming in will be decided by, as I said, these other external factors.
But Mahesh, morning firstly, and do you really think that the government's 100-day agenda, which should come up soon after maybe a cabinet reshuffle, if at all is in the offing, is it really going to address all these economic agendas that you just highlighted? Because while last time's election mandate back in 2014 was about development, this time around it's been pretty focused around nationalism. Do you really think the economy and what all needs to be corrected would be top of government's mind this time?
Well, I think you rightly identified the key differences, but the other big difference between 14 and 19 is that 14 there was a change of government, a change of bureaucrats at the top level and so on, whereas in 2019 the Prime Minister, the key ministers in the cabinet, also the top bureaucrats are going to be the same. They already know what the problem is. They've already started working on what the solution will be or should be like. So my sense is that the government will clearly be hitting the ground running this time as against back in 2014. And my sense is that the disruptive and yet the long-term positive oriented reforms are more or less done. I mean, whether we talk about the GST, I mean, yes, the implementation thing is done. Now we are getting into the more operational level issues, also the bankruptcy law, also the demonetization, RERA, etc. I mean, all those things were disruptive. All those things meant positive long-term outlook, but came with a short-term growth kind of disappointment. Now all those things are behind. I don't really expect too many disruptive changes going forward. So to that extent, I would say that the growth outlook definitely should be improving, and the government should be able to take the adequate steps.
Just looking at your note, and you're fairly confident that it's the mid-caps that are going to be back in favor. What is driving this confidence? Is it largely driven by the fact that the overall flow situation is likely to improve, and where within mid-caps do you believe there is value?
So two reasons for our confidence. One is definitely the flows, as I highlighted for the last 7-8 months. The inflows into the domestic equity mutual funds have been coming down, and I would say that one of the probable reasons for that was the political uncertainties weighing on the minds of local investors. Now that's out of the way, so the local flow should improve, which should be a positive for mid caps. The second is also the valuation. Now the gap between the mid cap valuation and the large cap is at a reasonable level, and I would say that that's the second factor that's kind of gives us confidence to be pushing mid caps here. Now within mid caps, the segments that we really like are the property developers, the cement companies, some of the other cyclical names like the EPC contractor, infrastructure, hotels, medical services. So those are broadly the segments that I would like to own in the mid cap space here.
I'm asking perhaps this question to everyone, which is that when NDA1 came to power, the underlying narrative for India changed. The view on earnings changed. Sectors like mining, construction, road, railways, they got completely re-rated. There was a entire re-rating moment for some of the PSUs also. But if I map the NDA1 regime, their economic policies have been very strong in terms of GST implementation, this entire IBC framework. But the challenges of a private sector capex are still there. Challenges of liquidity which were there have only deepened. So the question what we are trying to understand, Mahesh, is that do you think one should get excited but not euphoric?
Yeah, I think that's the right way to describe. Definitely a reason to be excited about. But not really that euphoric, because see, even the starting point on the market valuation is also different. I mean, right now we're sitting at 18 times 1 year forward earnings, right? So it's not really one of the cheapest market levels that we have seen. Also, if you look at the global developments, there are these sort of shadows of the trade war. There are these shadows of Brexit and a few other sort of global factors. Back in 2014, we were actually coming out of the taper tantrum environment, if you remember, and so there was a a positive tailwind from the global side and also from the valuation side, which is not really the case at this point in time. So yes, so to that extent, there is no need to be euphoric on the markets, I would say, at this point in time. Although, as I said, what can definitely be expected is the relative outperformance of India vis-a-vis the other markets.
Do you expect a huge consolidation happening in the PSU banking space? The process started. The process started with Dena Bank, Vijaya Bank, and with BOB. Do you think that is one space where we are in for a pleasant surprise?
Yes, I think the PSU bank consolidation is already happening. We are already down from 26 different state-owned banks, reducing to 19 as we speak. And the government has talked about their long-term goal to bring that number down from 19 to 6. So there is definitely things happening there. But does that mean that one should be going all out and buying some of these state-owned banks blindly? I would probably say no. Because when we talk about M&A and mergers, there are obviously some uncertainties that come to the fold. There are some weaker banks that will be merging with somewhat stronger banks, and what that makes to the balance sheet and the P&L of the stronger bank also becomes a question mark. So I would say I would rather go with a couple of large state-owned banks where the consolidation has already happened, and so to that extent there is a lesser amount of uncertainty. Maybe that probably a better place. But I would still say that even on the private financial side, the private bank side, the valuations are still reasonably good. So my first choice would still be that.
Do you think the groundwork has been done and the cycle itself has turned, and now with NDA2 there is a greater chance that we could be on a cusp of an earnings recovery? I mean, the point I'm trying to understand, Mahesh, is that where do you think the natural course correction because of policy and because of the economic nature is already behind us, and now seeds have been planted, it's time to start plucking the apples and the fruits.
That's true, because one of the biggest drag for the corporate earnings growth over the last 2-3 years has been the NPL recognition, the provisioning for the same by the corporate banks and the state-owned banks, etc. That has been the single biggest drag, and I can definitely say that the worst over there is clearly behind. The NPL ratios for the banking systems have already declined in the last 12 months in each of the last 4 quarters, and the P&L impact has also peaked out. The provisioning for those NPLs has also peaked last year, FY19, and FY 2021 we will now be looking at provisioning costs going down considerably, which will mean that the banking and the financial sector earnings growth will really be at a very high level in FY 20 and also in 21. So you're right to that extent. We have gone through the painful process of taking those write-offs, etc., and the time has now come to reap the benefits. Those benefits would mostly be seen in the corporate banking space.
Right. Mahesh, just wanted to understand the construct of the market. While you're betting on a broader market recovery and further upside to the benchmark indexes, when you talk about the benchmark indexes up until now, it's been a very restrictive move. It's been only the HDFC Bank and Bajaj Finances of the world which have given you that outsized performance. Are you betting on any new leaders, or do you think these two big ones will become bigger or gigantic after this, and there will be other names also which will participate along with the ride of the market?
See, by and large, what I would say is that over the last 5-6 years, we have seen the investment cycle has been quite weak. The gross fixed capital formation as a share of GDP continuously declined for the last 6 years. The economic growth was broadly driven on the consumption theme, with the private final consumption expenditure as a share of GDP rising consistently. And now that is beginning to change. Now we are seeing the consumption ratios as a share of GDP are topping out, in my view, and it's the time we start looking at the investment cycle improvement. And when we talk about investment cycle, I want to be very specific that we are essentially talking about the housing market recovery, because that is the one segment of the investment side which has been very weak, which I think is showing some initial signs of improvement. And so to that extent, I would probably say that some of the expensive staples and consumption names, where we have already seen some element of slowdown, where the valuations are anyway on the higher side, should be, the investors should be going underweight, on those names. And the investment side of the story, which is like the corporate banks, as an example, and more so the housing related names like the property developers, the cement, I would say even the housing finance companies, notwithstanding the NBFC problems, if you just focus on the some of the best names in that space, even those appear attractive. One doesn't really need to go down the curve in the housing finance space. So that is broadly the segment that looks interesting. Also, I would say from a valuation perspective, the the EPC, the contractors, also the infrastructure companies, those names also look attractive. So by and large, if you will ask me for the market construct, I would say that there should be a shift in the investment portfolios away from the expensive consumer names into the bottom of the cycle plays like the property developers, cement, etc.
You're not ignoring, or rather denying, the fact that financials will still be at the top slot, is it?
Yes, I would say that financials still look very attractive, and as I said, within that the corporate banks appear more attractive. I would actually be going underweight on IT and pharma. So I mean, okay, so pharma has been weak for quite some time, but IT has been doing sort of pretty good for most part of the last 5 years. But that's also a space that I would probably now look to underweight.
Add maybe autos to that list, because you have spoken about a consumption slowdown, especially within the auto space. We've been hearing that from a lot of corporate voices as well that we've been speaking to, and that really seems to be an inherent problem.
True. So autos is definitely part of the broader consumption theme, and within that I would say that as the investment activity picks up, the job creation picks up, it will eventually lead to improvement for auto demand as well, but that will probably take some time. So for now we would be underweight on autos as well. Within that I would say that the four-wheeler as a category looks more attractive from a longer term perspective, although may not be just as yet. But two-wheeler is not really a category that I would be looking at from a longer term perspective. Yes, there is a possibility that if the government were to review the GST rates on the autos and especially the two-wheelers, there can be some near-term up move in those names. But I don't think the two-wheeler as a category really offers long-term growth opportunity. Four-wheeler definitely looks better, but as we discussed, maybe there is some time for the demand to pick up in autos.
If you have to bet on NDA2 and allocate disproportionate amount of capital apart from private banks, which is the second segment you will choose, and let's say the time horizon is how best to make money during NDA2. If you have to come out with a report like this on Monday morning, I'm giving you a topic, what would be, how will that report start and how will that report end?
Well, I can be very direct. I would say apart from financials, the one space that I would look to overweight with a lot of confidence is the property developers. Because that is really a bottom cycle play at this point in time. We have seen 5-6 years of very weak trend. We are seeing we have seen a lot of disruptive actions hitting that segment, such as demonetization, RERA, GST, then the NBFC slowdown, etc. And yet if you look at the data over the last 6 to 12 months, the new housing unit sales have been rising consistently quarter over quarter, and the affordability levels are at very attractive levels, I would say. And within that, in the listed developer space, which are clearly saying the benefit of industry consolidation. So even if the property markets do not recover the way I am talking about right now, but the listed developers are definitely gaining a lot of market share, and that looks like a very, very attractive space to me.
Fantastic. Thank you for joining us.